Blerina, I feel like you would agree based on what I've seen for your own forecasts. So what does that mean for the Fed and the next couple of moves here?
So this is interesting because we are seeing this resilience of the economy. And by the way, I think a lot of what's supporting the consumer is the labor market. Aggregate incomes are strong and real disposable incomes are also improving now that inflation has decelerated. And then it seems almost contradictory that the Fed would lean against its forward guidance that would hike one more time this year. But I think this has a lot to do with what is happening in Treasury yields, especially in the long end of the curve. I think we're seeing yields increase, even though the probability of near-term hikes, according to market pricing, has declined. And I think for the Fed, there seems to be some equivalence where maybe the markets and the financial condition tightening that we've seen since September could be doing the job for them, so that does not necessitate another hike.
So what happens then, as we've seen, a couple of people are now thinking, Blerina, that maybe this move has run its course. If yields don't keep going higher from here, or maybe even come down a little bit, do you think the Fed would react to that by tightening?
So I think it's very key that the increase in yields we've seen so far is sustainable. I think this is the key. The Fed doesn't necessarily need to see further yield increases from here, but any pullback in yields, a meaningful one that brings us back to August levels, I think would be an indication that perhaps they need to deliver that extra hike if the economy remains as resilient as we've seen. And at this point, I have no reason, looking at the data, to believe that the labor market is going to crack anytime soon.
Steve, what were you going to say to that?
Well, I think it might be worth taking a step back and realizing that nominal yields right now in the 10-year are 5%. I don't think that continues. Growth right now is 5%. Nominal yields are 5%. So that means nominal growth is actually a bit higher, maybe 8%. So it's not crazy to be in a world right now of higher interest rates. While that does exercise some restraint, I think the Fed may step back and say, yeah, it's exercising some restraint, but not entirely clear that it's unwarranted given where the economy is right now. So I think things do step down here, but it's not a crazy place to be right now with 5% yields on the 10-year.
Blerina?
So I think another element that we haven't discussed so far is the lags through which monetary policy tightening and higher yields are playing out in the real economy. Key here is the duration extension that we've seen both for households and for firms. A large portion of U.S. households and firms locked in lower interest rates before the Fed started hiking. And so that means that, of course, the increases in rates that we've seen so far, which are substantial, are going to bite, but this is going to happen with a longer lag. So I think the Fed here is a risk manager, and what they're trying to do here is saying, okay, we will give the economy some more time for these long lags to play out, but then they're not precluding the possibility that if this resilience continues in 2024, they either can deliver fewer cuts than the summary of economic projections currently has in place, or they could resume hiking, depending on what's happening with wage inflation in particular.